Okay, good evening, everybody. Let's go ahead and get started. Okay, so as always, let's start with a sound check. Can you give me a thumbs up if you can hear me? Okay, excellent. All right. Okay, very good. Okay, everybody put their thumb up. Okay, so just a couple of announcements.
It's so important to know what to do after an
Let's see, I think somebody needs to mute. Let's see. Okay. Yeah, I think this today logging in, I noticed sometimes it automatically mutes you and sometimes it doesn't. So I think today is one of the evenings where you have to mute yourself. But a couple of administrative things first. So your last problem set has been graded, so you can find your score and then some feedback in the gradebook area of Canvas. And then also I noticed that people submitted their second project, so that's good. Some people submitted it like a few minutes before it was due, so that's okay. I guess you were working on it until the last couple minutes, which is also fine. So I will work on grading that starting tomorrow. And then also there's another problem set that's due next week. So I'll post that for you by tonight or at the latest by tomorrow, so you can get started on that. There's actually not that many class sessions left in the semester. So the semester is almost over and only a couple of weeks left. So I think at this point, people are kind of tired of the semester, ready for the semester to be over. So just hang in there and then we'll be done in the next couple of weeks and then summer break will start. With that being said, does anybody have any questions as we get started today about anything? Okay, let's take a look at the chapter 13 notes. So chapter 13, as you can see here, is going to go over three different areas. We're going to talk more about auditing. Okay, so we've been talking about not-for-profit organizations, but one part of not-for-profit organizations, or one area that we haven't discussed yet, is this notion of performing an audit. Okay, so we'll talk about different audit standards, and we'll talk about the fact that an audit is done for a for-profit organization, and also audits are done for not-for-profit organizations. So we'll talk about the different types of audit opinions that can be rendered. And then we'll talk about the most stringent set of auditing standards for entities that are not-for-profit, entities that accept governmental money and expend federal funds. This most stringent form of auditing is called the Single Audit Act, or OMB Circular A133. We'll do a problem in terms of how the Single Audit Act works. And then we'll talk more about taxes, okay? So you all have probably heard of a 501c3. Okay, this is one type of not-for-profit status that an organization can have. There's also a 501c1, 2. So we'll talk about what that means. We'll also discuss the fact that not-for-profit organizations have to file an informational tax return. Not-for-profit organizations don't pay taxes, but they have to file an organizational tax return called a Form 990. We'll discuss what that means. And then finally, we'll talk about unrelated business income. So organizations that are not-for-profit in nature, they get money from donations, but they can also make money by selling cookies or having a bazaar or like a yard sale. We'll talk about how that's handled. And then tagging on to that is this notion of performance evaluation. So we'll talk about different ways to evaluate how well a not-for-profit organization is performing. Okay, with that being said, let's get started here. So we have different auditing standards, okay? But first of all, let's talk about what an audit is. So an audit, maybe you've already taken auditing, but audits are performed by somebody that has a license. Generally, it's performed by a licensed CPA. And an audit basically does the following. It provides reasonable assurance that the financial statements are fairly presented. Okay, so when you have an audit done, basically you have another set of accountants that come in, and then they look at the financial statements. They double check to make sure that the numbers look good. And they're not guaranteeing that everything's 100% correct, but they guarantee that everything is reasonably stated in all material respects. Okay, so that means overall, everything looks fine. So you can take auditing and learn more about the details of that. But for-profit entities have to have an audit done, and also not-for-profit entities. So when it comes to auditing standards, we have 3 different levels of standards. So first we have GAS, Generally Accepted Auditing Standards. And this is the least stringent. More stringent is GAGAS, which is Generally Accepted Government Auditing Standards, or it's also called Yellow Book. So this is more stringent. And then most stringent is the Single Audit Act. We're going to do a problem on the Single Audit Act tonight, and this is the most stringent form of auditing standards. Okay, so we have GAS, which is least stringent, GAGAS, which is more stringent, and the most stringent standards is called the Single Audit Act. Okay. So in terms of the differences, there are more requirements or stipulations as you become more stringent. So if we look at the notes, and then we scroll down here, okay, this is Exhibit 1. Okay, so this Exhibit 1 on page 6, you can see that we have 3 different levels of standards. So each different level requires all of the requirements from the lower standard plus additional standards, requirements for the additional upper level standard. So for GAS, you have to provide an opinion on financial statements and supplementary schedule of expenditures of federal awards. So you have to say, do these financial statements look good, or do they not look good? And also you have to provide more information on expenditures that you have. Okay. Yellow Book, you have to do everything under GAS and then also report on internal control. Okay. Whereas the Single Audit Act requires you to provide an opinion on compliance with laws, provide a schedule of findings and questioned costs. So more disclosure, more accountability. Okay. What all of these different standards have in common is that you have to do a certain amount of testing. Testing means that you have to look at programs or transactions, and then you have to make sure that they look properly recorded and that there's all the paperwork behind them. Okay, so tonight we're going to talk about the Single Audit Act and how you pick programs to audit or test. Okay, so we can see we have these 3 standards. And if we scroll down, let's talk a little bit more about background. An audit, you can see, is here. Okay, so this is an audit. An audit is going to be the highest level of care. Okay, so an audit is performed in order to ensure that the financial statements are properly stated and an opinion is rendered in a financial audit. Okay. So if you've taken auditing, you know what the different types of opinions are. But for a financial audit, you can see that you have 3 different types of opinions. Technically, there's 4, but I've actually never seen one of these in real life. I worked as an auditor before I became a professor. So there's technically 4 different opinions that an auditor can render, but in reality, you only see 3. Okay. The most common opinion that you see is the following. So before I talk about the different opinions, what typically happens is that a not-for-profit organization, they have a team of auditors that come through. They want to look at your financial records. They want to look at your accounting system, and auditors perform tests. Okay. So they do what's called substantive testing. They actually look into the numbers, right? And they verify that the transaction is accurate, or they do analytical review, which means that they look at how much you have expense for a certain item this year compared to last year, and then they make a determination whether it's proper or not. When an audit is completed, there are different standards that have to be met, and the auditor is going to issue an opinion. Okay, this is the opinion that everybody wants to get. It's an unqualified, or also called unmodified, audit opinion, and this means that all financial matters are properly stated and the financial statements look good. Okay, that's an unqualified or unmodified audit opinion. Basically, it means everything is fine. So everything is okay. The second type of opinion is a qualified opinion. The qualified opinion that you can have here means everything is properly stated except or but, and then blah, blah, blah. Okay, so a qualified opinion might mean everything looks good except for your policy on recognizing contribution revenue. Okay, so that's a qualified opinion. Or everything looks good except for how inventory is handled. Okay, that's going to be a qualified opinion. Okay. The third type of opinion that you sometimes see, but it's very, very rare, is an adverse opinion. This means everything is not properly stated. This is an opinion that you don't want to get. And there's technically a fourth type of audit opinion, but it's very, very rare. And I've personally never seen this audit opinion in my life. And that's a disclaimer of opinion. That means that the auditor is saying, we have no idea if the financial statements are properly stated. So a disclaimer opinion basically implies that there is what's called a scope limitation. Okay? A scope limitation means, for example, that all of the records were destroyed, they were on the cloud, and there's no backup, and you have no idea if the financial statements are properly stated because there's nothing for you to examine or verify because the records don't exist. Okay, so you can see that that's an extremely rare circumstance. It might have happened in the past, maybe 20 years ago, if you had like paper records, if they were like burned in a fire or something, then maybe a disclaimer of opinion would have been rendered. But nowadays, you hardly ever see a disclaimer of opinion. Okay, but this is kind of interesting because why would a company pay an auditor to double check the books only to have the auditor say, well, we have no idea, you know, and then by the way, our fee is $20,000 for our audit services, right? So you're going to see one of these other three opinions here. Those are the most commonly seen audit opinions. Okay. So going back to what we see here, a financial audit is a maximum level of care. Okay, so if you have a financial audit, then this is going to be a level of care that's assessed at a maximum level. That means that the not-for-profit organization hires an auditor to come through. The auditor performs a financial audit, and the auditor has to have a maximum level of care. Now, an audit is not the only type of engagement that an auditor can perform. It's not the only type of engagement that a not-for-profit organization might pay for. Another type of engagement is what's called an attestation engagement. Okay? So an attestation engagement is where the not-for-profit entity is paying for a specific service. So you can see here, it's verifying a specific item or concern on the financial statements. So for example, a not-for-profit organization may hire an auditor to examine its inventory valuation. Okay, so for example, an entity may hire an auditor to verify inventory, disclosure, and financial reporting. Okay, so this is an attestation engagement. Of course, there has to be a level of care assessed by the auditor, but the level of care is not going to be at the maximum like it would be for a financial audit. Another type of engagement is what's called a compilation engagement. So a compilation engagement is what you did in financial accounting. In financial accounting, you had to take information and then create the financial statements, right? So that this is going to be another type of engagement that a not-for-profit entity can pay an auditor to do. Now, the last type of thing is unique to not-for-profit organizations, and that's a performance audit. Okay, a performance audit can look at certain programs. So sometimes it's called a program audit, right? But a performance audit, as the name suggests, is where you're having an auditor come in and they're going to be assessing economy and efficiency. Okay? So that means that they're going to be focusing on how effective or efficient you are at reducing cost and how much you achieve using a minimum level of resources. Okay, so economy implies, are you saving money or not? And efficiency means how effective are you? Can you get a certain outcome at the lowest cost possible, right? That's going to be assessed under a performance audit. And we can see here that when you have these different types of engagements, we have different levels of care, right? So here, again, the level of care is assessed at a maximum, whereas under these other types of engagements, the level of care is going to be lower than a maximum. Okay? So I want to explain what that means briefly. Level of care at a maximum, a lot of people think, well, you know, even if you do a compilation, shouldn't the auditor have a maximum level of care? In theory, that would make sense, but in reality, it doesn't work that way. And I have an example to share with you. So for example, let's say that I'm driving like my family in my car, like some of my grandmother and my parents or whatever, then I am super, super careful, right? My level of care is at a maximum, right? But if I'm like going to AU and commuting back and forth, I'm still very careful because I don't want to get into an accident or, you know, hurt other people or myself. So my level of care is still pretty good. It's just not at that extreme maximum level of care, right? So that's a good analogy to use because regardless of the type of engagement that's performed, there has to be some level of care. But if you perform a financial audit, the level of care is going to be extremely high because it needs to be, because the auditor is going to be looking at the financial statements of a not-for-profit organization and making an opinion. They're going to say, I think the financial statements are one of these four things. Okay? So you really can say that a not-for-profit organization, when they pay an auditor, they're paying for a piece of paper with an audit opinion. Right? When you did your project, you saw that even counties or private colleges or universities, they can have an audit opinion as well, right? Audit opinions can be assessed for the entire entity, right? Or they can be assessed at different levels, right? So you can see that opinions can be assessed for governmental activities, business type activities, major funds, component units, right? So you can perform an audit and issue opinions for different levels of the organization or different activities that the organization engages in. Okay, excellent. Does anybody have any questions on this so far? Okay. So let's take a look at this notion of auditing. So we know that we have three different levels of audits, and the most stringent level is called the single audit. So the Single Audit Act, or it's also called OMB A133, right? This is going to be something that an entity has to conform to if they receive and, not or, but and expend more than $750,000 in federal funds. Okay, so if you're a not-for-profit entity and you receive government grant money, if you receive and spend more than $750,000 of federal money, then you have to follow the Single Audit Act. So for the Single Audit Act, just know that the objective is that the Single Audit Act exists because they're trying to ensure that financial statements of the entire entity can be trusted, and it ensures compliance with federal laws and regulations, right? It's going to be performing an audit under GAS standards, right? And you're going to be looking at different programs. Okay, so let's see what that means. First of all, just a little bit of basic auditing theory here. AR means audit risk. Okay? So why do you perform an audit? You perform an audit to reduce audit risk. Okay? Okay, so an audit is performed to reduce audit risk. Okay? So audit risk is based on three different factors. Okay? So audit risk is based on inherent risk times control risk times detection risk. Okay, so what does that mean? So audit risk is something you're trying to reduce. The whole purpose of doing an audit is to reduce audit risk. So how do you reduce audit risk? You reduce audit risk by verifying transactions, looking at the financial statements, right? But overall, audit risk is based on three different factors. Okay? So the first is called inherent risk. Okay? So inherent risk is something that you can't control. Inherent risk is systemic risk. That means, for example, that this is not a not-for-profit organization, but if you were to audit a casino handles lots of cash, right? That's just what casinos do. So that's a risk because you handle a lot of cash, but you can't do anything about it. You just have to accept the inherent risk. Now, you can reduce audit risk by trying to reduce control risk. Control risk is the risk that the internal control system will have some kind of problem associated with it. Okay, so control risk equals the risk that the internal control system has a problem. And so that's control risk. So how do you reduce control risk? By examining the internal control system, trying to improve the internal control system, right? Internal control means basically, what is the company doing to make sure everything is properly stated, right? So for example, if you have like a safe, that's an internal control procedure. So an auditor can try to look at what the company is doing in-house, and they can try to reduce control risk that way. Detection risk is the risk that a misstatement won't be detected. Okay, so that's detection risk. So with detection risk, you can reduce detection risk by examining more transactions. Okay, so the more transactions you examine, the more you can reduce your detection risk. Okay? So as an auditor, you're trying to reduce your audit risk to a level that you can accept. You can't make this zero. And just know that audit risk is a function of three different separate components. The first part is risk that you can't do anything about. You just accept. The second is risk that the internal control system will have a problem. So you can try to improve the internal control system and reduce your control risk, or you can do less internal control procedures and then allow the control risk to be high. Detection risk is the risk that you're not going to detect something. So if you want to make detection risk go down, you can look at the transactions more carefully. You can do more substantive testing. That's going to reduce your detection risk. What we're going to be focusing on with the Single Audit Act is this notion of detection risk. So with detection risk, how do you reduce it? Okay, so how do you reduce detection risk? So you reduce detection risk by testing programs and transactions. Okay, so the Single Audit Act provides you with guidelines on how to pick programs to test. Okay. So let's take a look at how the Single Audit Act works. Okay, so this is Exhibit 4. The Single Audit Act is a risk-based approach. Okay. So these are 4 different steps that you're going to perform. Okay, so you can look at this yourself. Basically, you have to identify 4 different dimensions. You have to identify type A or type B programs, and then you have to identify high and low risk programs. Okay, okay, so let's go back and then see what that means. Okay, so for the Single Audit Act, we have to do the following. We have to say, okay, is a program a type A program? In other words, is it a major program? Or is it a type B program? That's a non-major program. So type A programs or type A expenditures are what are called high dollar value. Type B are low dollar value. And then you have to look at how risky a program is. So a program can be either high risk, right? So we can say here high risk, or a program can be low risk. Okay, so when you're performing the Single Audit Act, you're going to categorize everything. And based on which category it is, you're going to test the program or not. Okay, so we can make a matrix here and then see what we mean this way. So a program can be either type A, right? High risk, or a program can be type A, low risk. Okay. A program can be type B, high risk, or it can be type B, low risk. Okay, so you can have either A high, A low, B high, B low. Okay, so what does A high mean? A high means high dollar value program, risky program. Type A low risk means high dollar value program, not very risky. B means low dollar program, very risky. Or type B low means low dollar program, not risky. Okay, then what you're going to do is you're going to test all type A high risk. Okay. I mean, that makes sense because anything that is a large dollar amount and very risky, you definitely want to test, And then you want to select more programs in order to get at least 50% coverage. Okay. And then just know that additional variations of this rule exist. Okay, so, all right, I don't know if that makes much sense because this is just all theory, but let's do a problem and then see how this applies. Okay, so let's take a look at the notes. Okay, and then we'll look at Exhibit 5. Okay, so this is the Single Audit Act. Okay, so Single Audit Act says that you either have high dollar value, which is type A, or low dollar value, that's called type B. Okay, so high dollar value programs, right? How do you know if it's high dollar value? Well, how much federal money are you spending? The most common category is here. Okay, it's very rare to get like, $5 billion from the government. Okay, if you did, then you would have to use this rule here. But most entities that get federal money are going to be in this first category. They get between 300,000 and 100 million. So how do you know if something is high dollar value? You take whatever's bigger, 300,000 or 3% of total federal awards. Okay, so that's how you know if something is type A or not. Okay, type A means high dollar value. How do you know if something is high risk? Well, high risk is usually the default. If you don't know how risky something is, then you assume it's risky, right? Because that's the safe assumption to make. Or if you're familiar with the program, there are signs that a program can be high risk. And these include a weakness in internal control, significant monies flowing in and out of the funds of the not-for-profit organization, a newly installed computer system, right? So if you have a new information system that you haven't tested yet, then you assume that it's going to be high risk. If you haven't had any recent audits done, if nobody's actually looked at the books, then you assume that that program is going to be high risk, especially if the audit hasn't picked up that program. Or if you have complex compliance requirements, that's a sign of a high-risk program. Or a program that's relatively new, right? That's also a sign that the program is high risk. Okay? So you can see these requirements up here are going to be the rule that you use to figure out if it's high dollar value type A or low dollar value type B. And then a program is either high risk or low risk. If you have no idea, you assess it at high risk, or if you see one of these signs or more of these signs here, then you assess it as high risk. Okay, so let's take a look at an example together. But are there any questions so far? Okay, let's take a look at the notes. Here. So before we do this is problem number 4. Okay. Let's take a look at the first 3 multiple choice questions. Okay. Okay, so it says in number 1, an audit of a government conducted in accordance with generally accepted auditing standards includes. What does an audit include? Remember, gas is the lowest level of standards. The answer is going to be B. Okay, now C is a tempting answer because you would assume, well, okay, doesn't an audit also ensure that you follow the law and regulations? Not per se. And also, certainly it doesn't test for that, right? An audit, especially when it's performed under gas, which is the lowest level of standards that you can have, actually just tests to see if the financial statements look good or not. They're focusing on the numbers, okay? So number one is a little bit tricky, but the answer is B. Okay. What about number two? What is the purpose of the Single Audit Act? Okay, this one is also tricky because all the answers sound good, but the answer is B. The purpose of the Single Audit Act is to promote efficient and effective use of audit resources and consolidating audit activity. What about number three? What do you think about number three? Okay, so the answer to number three is D, right? Entities expending under $750,000 a year are exempt from the Single Audit Act, right? So how do you know if you have to follow the Single Audit Act? You receive and spend, right, more than $750,000. A is the most commonly picked wrong answer. And it's wrong because it says receive, right? You have to receive and spend over $750,000. So it can't be A. Okay, excellent. Okay, so let's erase these answers, which I put on here, because we'll figure these out together. Okay. Let's take a look at this question here, so you can look at it yourself. Here we have an entity, a not-for-profit organization, and they receive and they spend federal money, right? And it looks like they receive and spend a lot of federal money. So they spend the money by having different programs. So each program spends money. For example, program A spends $6 million. Program B spends $400,000, right? So take a look at this problem. And then if you want to try to maybe see if you can do it yourself, that would be good. I'll give you just a few minutes. Okay, sorry about that, folks. There was an important phone call I had to take. So, okay, so let's go through the answers here. Okay, so it says, does ABC agency need to comply with the Single Audit Act? I hope so, because if the answer is no, then there would be nothing more to do with this problem. So the answer is yes, right? Because they received and expended more than $750,000 in federal funds. Okay, so we know they receive federal funds because obviously this is federal money, so they must have received it. And then clearly it's saying that they expended $13,503,000. Right? So yes, they have to comply with the Single Audit Act. Next question says, what is a type A and what is a type B program? Remember, type A is a high dollar value. That means a lot of money, right? Type B is a low dollar value program. So that means it's less money. Okay? So then the question is, well, how much is a lot of money? And what does type A mean? What does type B mean? Okay. So what is type A? Well, we're going to use this rule here to figure out what's type A. Okay, so type A is, you can see here, either $300,000, right? Or 3% of the total. So we'll take 3% of the total, which is this number here, 13,503,000, okay? Which equals $405,000. Okay? So we have to take the bigger number. Okay, so 300,000 or 405,000. 405,000 is the bigger number. Okay. So that means that type A is anything that is greater than or equal to $405,000. Okay. So if a program expends $405,000 or more, it's type A. If it's less than 405,000, it's type B, right? So type B is less than $405,000. Okay. All right. Then it says which programs should be selected for audit and why. Okay, so there's variations of the rule that you use, right? But we have to definitely audit all type A high-risk programs and then select more programs to ensure at least 50% coverage. Now, what does that mean, select more programs? So there's different variations of rules you can use. You can say you have to pick one type B high risk. For one type B high risk, pick one type B low risk. What you need to know for this class is to pick all of the type A high risk programs and then pick more programs until you get 50% coverage. Okay. The basic rule is that you're going to do the following. You're going to say, pick all type A high risk. And then if you need more programs to get 50%, then do type B high risk, right? Because type B high risk is the next level. Then if you need more programs, go with type A low risk. And then if you still need more programs, go with type B low risk. The reason why you would follow this order is because type A high risk is large dollar value, risky. So it's something that you definitely have to look at. If you need more programs to cover 50% of all the programs, then B is a low dollar value, but it's also very risky. The fact that it's very risky means pick from the type B high risk. If you need more programs, then go for type A low risk. at least type A is a lot of money. It's a big dollar value, even though it's not very risky. And then number 4 on the list is type B, low risk. Okay, so based on that, which programs would you pick? I'll let you select that. Okay, so let's take a look at which programs you would audit. Let's categorize these. Okay, so let's take a look here. It says programs A and E were audited as major programs in each of the last 2 preceding fiscal periods. Okay, so we looked at A and E in the last 2 fiscal periods. Okay, so if you looked at A and E, then probably A and E are low risk, right? Because they were already audited. Okay, so A is low risk. Okay. And then E is low risk because it was also looked at pretty recently. Okay. Then I don't have any information about the other programs, so we know they have to be high risk, because if you're not sure, then assess them at high risk. Okay. Okay, excellent. Okay, and then let's go back and see which programs are A and which programs are type B. Okay, so anything that's 405 or bigger is type A. So this is type A because it's $6 million. So this is type A. And that's A low. This one is under 405,000. This has got to be a type B program. It's B and it's still high risk. This program is over 405,000. So this is type A, high risk. Okay. This one is a big number, over 405,000. So type A, high risk. And then this one is under 405,000. This is going to be a type B, low risk program. Okay, so let's see. Which programs are we going to audit? We'll say we'll do all the type A high risk. So we're going to look at this program, okay, and then this program. Okay. Okay, so let's add that up and see what happens. So we will audit for sure. We need to do program C and D. So program C and D. Okay, then let's see. If I do program C and D, how much coverage do I have? Okay. That might be enough, actually. So program C is $1.1 million, and program D is $5.6 million. Okay. And that's $6.7 million if I add up these two numbers here. Divide by the total, 13,503,000. So that is 49.6%. Okay, so it's not enough, right? So I added up these two and then divided it by the total, and it's 49.6%. So I need one more program. Okay, so since we audited all the type A high risk, we can go with type B high. So we can go with program B, right? If I had more than one type B high risk, you can pick, right? So if I had, let's say this program B was B high, and then I had program E was B high, just pretend, then it's up to you. You can pick, you have some discretion. Okay, so since this is the only B high, we'll go with program B. Okay. Okay. So we're going to audit this program also. And then let's do the computation again. We're going to add up the totals for these and see how much it equals. Okay. Okay. Divide this by the total. So that's 52.5%. Okay, so that's enough. Okay. Now, the thing about the Single Audit Act is that it has rules that you have to follow, but also there's some element of randomness, right? So, for example, you may decide, well, I want to audit program A also. I'm going to add that to the list. Or if I had, multiple B high programs, maybe I'll pick this program, but not another program, right? So there is some element of randomness to this. And the purpose of the randomness is so that the entity, the not-for-profit organization, never has a perfect idea of exactly which programs are going to be audited, right? Because if they know exactly which programs are going to be audited, then it's kind of not as effective to have an audit, because they'll just make sure that these programs look good and they're not going to worry about the other programs because they have no fear that they'll ever be looked at carefully, right? So Single Audit Act, what you need to know is classify everything as either A or B, high risk or low risk, and then audit all of your A high. And then if you need more, like you need to get 50% coverage or more, then go for the B high, and then A low, B low. Keep adding until you get at least 50%. Okay? And then also know that there's variations of how this rule works, so that it's not going to be totally predictable. Okay, excellent. Are there any questions on this? Okay, let's go back to the notes here. Okay. So we'll go back and then we're going to talk next about taxes. Okay. So in terms of taxes, we can look here at this page. Okay. So when people think about a not-for-profit organization, they usually use the term Section 501c3, right? So a tax-exempt organization is a Section 501c3. That's true, but it's not always true, right? Depends on what kind of organization you are. So a Section 501c3, as you can see here, is an organization that's religious, like a church, a charitable organization, scientific, literary, educational, right? Amateur sports organizations, organizations to prevent cruelty to children and animals. If you are a 501c3 organization, you can't engage in substantial political activity. Okay, so that's a Section 501c3. There's also different types of not-for-profit organizations. Okay? So if we look at the notes, we scroll down, you can see a list here. Okay, this is Exhibit 6. Okay, so 501c3 is the charitable type of organization that everybody's familiar with, right? What about a cemetery company? That's a 501c13, right? How about a veterans organization? 501c19, right? How about a farm cooperative, right? Like I have a friend who lives in out in St. Mary's County. There's farm cooperative organizations there. They're not for profit in nature, and sometimes they have like events that they hold. That's a 521A, right? So you can see that this tax exempt status encompasses more than just a 501c3. Okay, so you don't have to memorize this, just know that there's more than just a 501c3. Okay, also, not-for-profit organizations have to file a 990. Okay, so a 990 is an informational tax return. So typically you think about a tax return as something that you file because you have to pay taxes. Well, a not-for-profit organization doesn't have to pay taxes. They file a 990 tax return just to show how much money was coming in, how much money is going out. They also file a 990 to show how much some of their officers made, right? Okay. And then there's a question in the chat. The question is, do not-for-profits still have to match employee Social Security and Medicare taxes? They do if they have employees that earn a regular W-2 salary. So yes, they have to pay Social Security and Medicare taxes. Yeah. Okay. What about this next thing here? UBI, unrelated business income. Unrelated business income is a tricky subject because not-for-profit organizations, if they receive donation revenue or contribution revenue, they don't have to pay taxes on that. That's pretty obvious and clear. But what if a not-for-profit organization has unrelated business income, UBI? Unrelated business income is simply revenue from an activity that normally doesn't involve the mission of the not-for-profit organization. Okay. So this is unrelated business income. So what are some examples of unrelated business income? Like what are some things that maybe like a church or synagogue or would engage in to earn some extra cash on the side? A bake sale, right? Selling t-shirts. Right? What else are some examples? School bookstore, yeah. Yeah, okay, so it could be, right? So maybe you have like a bookstore. Maybe you sell clothes, right? Maybe you have like some type of like festival, right? And that's considered to be unrelated business income. Because if you're a church, your mission is to maybe help the community and provide services to your congregation, right? So if you have a bake sale and sell like beer and cookies or something, that's clearly unrelated business income, right? So unrelated business income is a touchy subject because do you have to pay taxes on this or not? Even if they donate those things, that's a good question. Okay, so that actually ties into whether you have to pay taxes or not. Okay, so what if I'm a church and I have like a festival or like a bake sale? You don't have to pay taxes, tax exempt, if the activity is not carried on regularly. So if you have like an annual bake sale, you don't do it every week, you don't do it every day. You have unrelated business income, yes, but you don't have to pay taxes on it. What about if you have an event run by volunteers? Then you don't have to pay taxes. And then this is Charles's point. What if you sell items that are donated, right? If you sell items that are donated, then you don't have to pay taxes, right? Okay, so you can see here that we have a list of different reasons when you have to pay taxes or not. Okay. So look at this list here, and then we'll go down and then look at this problem here, and then see if you have to pay taxes or not, and we'll go over the answer. Okay, let's take a look at this question here. We have the Silverton Symphony Orchestra. Okay, so they are a 501c3. And then this is underlined here on purpose. Its mission is to increase access to the arts for the community of Silverton. Okay, so they have the following unrelated business income activities. And the question is, do they have to pay unrelated business income tax, UBIT, right? So how do you know if they have to pay unrelated business income tax or not? Well, a quick test is this related to their mission or not? If they do something that's related to their mission, then there's no unrelated business income tax. Also, look at the list that I gave you, and then see if you can make a determination of whether they have to pay taxes or not. Okay? So let's take a look at these together here. Okay, so it says they have a sale, okay, who listens to CDs? But it says sale of Silverton Orchestra concert CDs in the facilities gift shop. Okay, so first test, you can figure this out conceptually. Does this increase access to the arts? I mean, I guess, because you can listen to music. And if it's part of the mission, then you don't have to pay taxes on it. Right? So we can say, okay, well, I don't think you should have to pay taxes on that. Okay. What about number 2? It says rental of the facility to the high school drama club. I think if you rent your facility to a high school drama club, that increases access to the arts. That's related to your mission. You don't pay taxes on that. Okay. Okay. What about number 3? It says rental of 2 apartments in the facility to the symphony. Well, if you rent 2 apartments, let's take a look at the list here again, if we're not sure. So somebody in the chat is saying maybe they do have to pay taxes. Okay. Okay. What about if you have here? It says operated for convenience of employees and patrons, like you have a cafeteria, right? If you rent out space for somebody to sleep overnight, right? If you rent out an apartment, should you have to pay taxes? Well, it depends on who you're renting it out to. If you're renting it out to the symphony, right, itself, right, then if the symphony includes employees and patrons, then probably you don't have to pay taxes, right? So the problem has to be very specific, but here you would not pay taxes. Okay. This seems so wrong, number 4. What happens if you sell your ticket membership list? Okay, I feel like that's happened to me all the time because I get like weird text messages from people, or you get like like tons of emails after you provide your information to buy something. If an organization sells their membership list and gets money for that, do they have to pay taxes or not? I hope they would have to pay taxes, but unfortunately, the rule is, if you look here, if you sell your rental or membership list, it's tax exempt, okay, which is, I think, crazy. So you don't have to pay taxes on that. The question is, why is that? That's an excellent question. I think it's probably more of a political thing. Probably not-for-profit organizations lobbied and said that, if we sell our membership list, then we shouldn't have to pay taxes on that. I think that personally, the laws are configured in such a way that your privacy is not really protected as much as it should be. That's my personal opinion, right? Like, for example, if your Instagram account gets hacked, they just tell you to change your password. But if you ask them, well, what information was hacked and what information was taken from me, they don't tell you that, right? So I think that my personal opinion is that your privacy and your information isn't protected as much as it should be. That's my opinion. So until they change the law, the answer is going to be not subject to tax, which is, pretty sad, but unfortunately the truth. What about number 5? This one I think is pretty clear. You rent the facility that you have to a state CPA association for continuing education events. Does that have anything to do with your mission, increasing access to the arts? I don't think so. Is it like on the list as one of the exceptions where you don't have to pay taxes? No, this is like a normal business activity. You should pay taxes. What about 6? Internet sales of gift shop items with the Silverton Symphony Orchestra logo, like a handbag that has the logo. Does that increase access to the arts? What do you think? I mean, if it increases access to the arts, then you don't have to pay taxes. If it doesn't increase access to the arts and you do it all the time, it's not one of the exceptions on the list, then you should have to pay tax. What do you think? Is it no tax or is it tax? Okay, this one I think is not clear, because is having a logo on something, does that increase access to the arts? I don't know. If there's like a website address, maybe you could argue yes, maybe you can argue no. Right? But what about 7? If you lease the facility's parking lot to a school on a football game day, does that even increase access to the arts? I don't think so. So that means it's not on the list. You should have to pay taxes. Okay. Excellent. Okay, any questions on this? Okay, let's go back up here. Let's see if we can answer some of these questions here. Okay, so number 5, which of the following would be a 501c3? What do you think? (501c3) is a not-for-profit organization that is a charity, a church. Typically, it would help individuals or provide services. So D is the answer. What about number 6? Why might a not-for-profit fail to qualify for tax-exempt status? We'll talk about this next. But you can be a not-for-profit and lose your tax-exempt status if you pay officers excessive wages, right? Or if you engage in a lot of political activity. Okay? As a matter of fact, if you pay an officer excessive wages, then that means that that person is getting some type of excess compensation, right? Which can be defined as, for example, the officer like selling their car to the organization, and the officer gets more than the fair value of the property. Like, the president of a not-for-profit sells their $2,000 beater car and gets $100,000 from the not-for-profit. That's a form of excess compensation, right? Or the not-for-profit is going to sell like their iPhone 14 Pro 1 terabyte for $10. It's a brand new phone. That's a bargain sale, right? If that happens, then the not-for-profit can be subject to sanctions. Okay, we'll talk about what that means. Okay. And then number 8, the answer is B. Okay. So income considered to be unrelated business income for an organization that provides immunizations. That would be unrelated business income is something that is not really part of the mission of the organization. It seems like a side activity. So if you sell sweatshirts, right, that would be most likely, right, most likely to be unrelated business income. All right, excellent. Any questions on this? Okay, so what happens if a not-for-profit organization pays its officers excessive salaries? Well, that's called an intermediate sanction. So intermediate sanction is where you could lose your tax exempt status, right? So the IRS may assess penalties, fines, or even revoke not-for-profit status. Okay, so if you're a not-for-profit organization, when might you be subject to an intermediate sanction? That would happen if you provide excess benefit to a disqualified person. Okay, what does excess benefit mean? It means unreasonable compensation, selling something to the officer or disqualified person at a bargain price, right? So if you give somebody an excess benefit, and that somebody happens to be a disqualified person, somebody that has substantial influence over the organization, then that is an intermediate sanction activity. Okay, so for example, let's say that the president of a not-for-profit gets a free car worth $150,000. Okay, so if the not-for-profit entity were to do something like that, first of all, this is an excess benefit. Okay. That's the free car. And the free car is given to a disqualified person because it's the president of the not-for-profit. That's an intermediate sanctionable activity. Okay. Okay. The reason for all of this is so that you don't create a not-for-profit organization and use it as some type of tool to pay the founder a ton of money, or you create a not-for-profit organization where the top management of the organization gets ridiculous amounts of salary benefits, and then on top of it, the organization doesn't even pay taxes. Okay, so let's take a look at an example and see if we can figure out intermediate sanction, in other words, excess benefit to a disqualified person, both things, right? So we'll take a look at this question here. Okay, so it says, number one, Jane is the president of a public charity and personally owns a building that she has decided to sell to the not-for-profit organization. The building is worth $200,000, but she gets $250,000. Is this an excess benefit? I think so. Disqualified person? I think so. And yes, this is a intermediate sanctionable activity. Excess benefit to a disqualified person. What do you think about number two? Yes or no? I underline this here, no limitation. I would say yes, right? Because the president is a disqualified person. It's an influential person. And are they getting an excess benefit? Yeah, you could argue so, because they get a percentage of increase in gross revenue, right? So they get a percentage of the increase in gross revenue. There's no limit. Okay, so they could get an ridiculous amount of money, right? So that would be an intermediate sanctionable activity. What about number 3 with Anne? Anne is a member and director. So director is pretty influential. She gets 20 free tickets. Anne is a disqualified person. And is this an excess benefit? I would say no. Both things don't exist. Right? And then in the chat it says, but these questions are more of an employee. You're getting paid than the not-for-profit itself. The answer to answer 3, yes, the gifts are taxable. Yeah, the gifts are taxable. The gifts are not taxable because these are free tickets. They have no value, right? So if Anne gets free tickets, then they were free to begin with. So there's no excess benefit. If the tickets had some value, then that would be different. Okay, what about number 4, Joe Curtis? Oh, in the chat it says, I thought she received it for free, not that the tickets. Oh, the tickets are free tickets. 20 it says 20 free admission tickets, not 20 admission tickets for free. Yeah, so that's kind of a wording thing. Okay, I think the answer is no, because that's the only answer choice left. How come 4 is no? Why is it no? The reason why is because when the salary was negotiated, it says Joe was recently hired, right? So Joe was not a disqualified person when the salary was negotiated, right? So you can argue that Joe is not a disqualified person, right? Because they said, okay, we'll offer you this salary. Joe had nothing to do with, I mean, Joe could either accept the salary or not, but Joe had nothing to do with the salary in terms of being like an influential person, because they didn't even hire the person yet, right? So the answer would be no. Do you have any questions about 1 through 4? Like, do you want to argue any of these questions or unsure about any of these? Okay. All right. The last thing I will tell you is from the notes, performance evaluation. So performance evaluation, we learned program expense ratio. That was on the last problem set. Program expense ratio is program expense, like how much money you spend actually fulfilling the mission of your organization, divided by like your total expenses. So what you should know is that when it comes to performance evaluation, you can have different types of metrics. Program expense ratio is the most famous metric you can use. You can also measure performance by looking at inputs, like how much are you putting in? Of course, output or outcome, how much are you getting out, right? Or some combination of the two, right? Effectiveness or efficiency. So let's take a look at these 3 different types of performance evaluation metric tools. So either input, like what are you putting in? How many hours are you working, for example? How many new workers or volunteers are you hiring, right? Output, how many people do you help in the community, right? How much do you raise how much do you raise the salary for people that are in your training program, right? Or efficiency, how long does it take to respond to a request for help, right? So you have these three different types of measurement metrics that can be assessed. And if you look here, you can see some examples. Okay. Look at some input examples here. How many hours do you spend training your employees, right? That's an input measure. Output or outcome, response time. How many, if you put out fires, how many square feet of a fire do you put out, for example, right? This is for a fire department. How much do you spend per capita, for example? Okay, so you can look at input, output, or efficiency. Or efficiency is also, are you getting a certain outcome by minimizing the input? In other words, it's a combination of input and output measurements. Okay, so we did a lot today. We go back up to the notes here. We talked about auditing, right? We talked about the Single Audit Act, and we did a problem. We talked about taxes, right? With taxes, we talked about unrelated business income tax, and intermediate sanction, right? That's a disqualified person that gets an excess benefit. And then we briefly talked about how you can evaluate the performance of a not-for-profit organization. Okay, so I wanted to finish a couple minutes early to see if anybody has any questions, had any questions. Do you have any questions about anything tonight? Okay, if you have no questions, I'm going to post the next problem set probably tomorrow morning, and it'll be due before class next week. Okay, so look out for that. And then next week, we're going to go over chapter 14, which is federal accounting. Okay, so you can look forward to that. And if you have any questions, or if you want to go over anything or have any concerns, let me know. And then we'll see you all online next time. Have a good rest of the evening.